present a paper on volatility and price spillover between financial markets and gold, financial markets and commodity markets. So especially the focus of the paper is on the change in the interrelations between financial and commodity markets. Now the interrelations between financial and commodity markets is not new. There have been certain work, but here the focus is on the change in the interrelations, possible changes, because it has been observed that after COVID-19 across the globe, stock markets have observed a lot of volatility. So it might have happened that the interrelations between the commodity markets and the stock markets have changed. So it has been observed that correlation between commodity and equity markets have increased since the beginning of 2000. Now, when we talk about commodity markets, I am focusing on two commodities. One is the gold, and the other one is the oil, crude oil, because these are the two commodities which have been observed to be acting as kind of safe haven assets, or as Professor Mohapatra was telling today, that it's flight to safety kind of things. And it has been observed that there is a distinct relation or interlinkage between these two commodities and the stock markets as a financial market. So the linkage basically is like this: if there are oil price variations or energy price variations, these are going to affect the corporate cash flows, so their stock prices will also be affected. And if we talk about the energy prices and gold, so what happens is that if energy prices increase, normally inflation increases in a country, and if inflation increases, then people have a tendency to move towards more safe assets. So they move towards more of gold. So these are the interrelations between the commodities. So I am going to focus on gold, energy, and stock prices. Now, finding out the interrelations will be important, and because there are a lot of work on developed markets earlier and even after COVID. And in the context of emerging markets also, there have been works prior to COVID. And after COVID, there are certain markets which have been focused on. But interestingly, no trends have emerged. Means we cannot say that in developed markets, interrelations happen like this, and in emerging markets, interrelations happen like this. So there are mixed evidences, and they vary from one emerging market to the other. That's why country experiences are important, and we are focusing on India. Now, if we talk about India, it's not only pre and post COVID. We are also looking at the effect of pre and post Russia-Ukraine war that has started last year in February. So we have taken the data and we have tried to find out the effect of that also, because in literature there are evidences that such interrelations between commodity and financial markets are also influenced by these geopolitical events or increase in political uncertainty. So the objective is to find out the nature of interactions among stock, gold, and the crude oil markets for both pre and post COVID, and for both pre and post war. And for not only the spot prices, we are also looking at such interrelations into futures prices, which has not been explored much for India so far. So I'll not elaborate on the literature much. So I'll just mention that, as I was mentioning, that country experiences differ. We can see that in Qatar and China, crude oil is a source of positive return transmission in these two countries, whereas in US, it's a negative transmission between oil market and the stock market. So the evidences are not same. On the other hand, there are bidirectional spillovers, means if we consider these markets, sometimes a spillover is from financial to commodity markets, sometimes it's from commodity to financial markets in certain other countries like GCC and all. And as I was mentioning that geopolitical events also have impact on interrelations. There are evidences in US, there are evidences in China also. So that's also important. And the evidence pertaining to India before COVID, if we look at, again here also the results are a little mixed, and we have seen that till the data just after the global financial crisis that have been explored in the Indian context, how the interrelations have been pre and post global financial crisis. And it has been observed that around 2014-15, there has been weak relationship between commodity and equity markets. But if we move forward from the global financial crisis, correlations between crude price and stock return and gold and exchange rates were higher during the global financial crisis. This is a very important result because later on it has been observed that after this effect has come down, again the correlations have waned. Okay? And equity markets have a return spillover on commodity markets sometimes, and so there are evidences of bidirectional spillover. In another paper, we have found in 2022 that previously pre-COVID, the levels the prices at levels were impacting one another, but after COVID, it's the volatilities in the returns which are affecting this kind of spillovers. So given this thing, we have done this work as I have mentioned in the objectives. So regarding the data, we have taken both Sensex and Nifty, though I'll be showing only the results of Sensex because the results are qualitatively similar. And crude and gold spot prices were sourced from MCX, and for futures prices also we have taken it from Asia Index website and NSE website. And for the commodity returns, we have taken, futures, commodity futures, we have taken gold and oil from MCX. And the data pertains to June 2017 to May 31st, 2022. And there was a specific reason to take June 17 because the government has given the permission to go for dynamic oil pricing from June 2017. And we wanted to examine the effect in the more recent period, so we did not go back prior to 2017. So this is the plot of the raw data of spot prices and the future prices. So if we observe from 1st June 2020, means just after COVID, all the prices are fluctuating a lot, both in the spot and in the futures. We can see from the graph that all the prices are fluctuating after COVID. Now, how we have measured the volatility spillover? We have gone for estimating diagonal BEKK model by which we find out the dynamic correlations. Means every day the correlation between the three markets are changing. So we have estimated the dynamic correlation based on the diagonal BEKK model, and we have taken the pre and post-COVID as the date is January 31, 2020 onwards is post-COVID because the first official case of COVID in India was reported on that day. And for war, we have taken February 25, 2022. So obviously, we did not have much data post-war, and we have not got very concrete results for war also. But the COVID results are quite robust. So these are the 8 diagonal BEKK model that we have estimated. First two are for spot prices pre and post COVID, then spot prices pre and post war. Similarly for futures prices pre and post COVID and pre and post war. So these are the 8 BEKK models we have estimated. And if we look at the summary of the results, we have seen that the arch and Garch effects are significant, which means that the volatility, whenever there is a shock in all these three markets, the shock is quite persistent. Moreover, own volatility, when it increases, suppose in the stock market, if there is a shock and the volatility is persisting, and moreover, it is also going to affect further volatility in the next periods. So if we look at the BEKK model, I'll just show you one table on pre and post COVID for spot prices. This is the result for that. The left one is pre-COVID result. As you can see that in pre-COVID period, BSE was affected by gold. Crude oil was also, the returns in the crude oil market was also affected by gold and all. But if we look at the post-COVID, we can see that none of them are being affected by them. So this is at the return level I am talking about, not at the volatility level. only thing is DLP crude, that is the price of crude, is affected by the stock markets. So the relationship have definitely changed, and if we look at the volatility further, I'll just show you the graphs. Pre and post-COVID, the upper one is the pre-COVID and the lower one is the post-COVID. As you can see that in the pre-COVID period, the BSE and gold relation was negative. The correlation was negative and it was around minus 0.2 to 0.4, minus 0.4. But that has become almost zero after post-COVID. And interestingly, the blue line, if you look at, that is the correlation between BSE and crude oil. That was almost zero. That was hovering around zero. This has increased a lot, and a lot means it's 0.6 to 0.8 sometimes. This high, and this is a very high positive correlation observed for the entire post-COVID period. This is exactly the same thing which has happened in the global financial crisis also. And it's a repetition of the same thing that we are seeing in the COVID as well. We have also done variance decomposition, which can give us some sense of direction of spillover, like from which market to which market the shock is coming. So if we look at this circle, so we can see that during the pre-COVID period, if we look at row-wise, we can see that be it BSE or crude or gold, if there is any shock in any of these markets, it is being explained by, its variance is mostly explained by its own variance. So other variables are not affecting in the pre-COVID period. But in the post-COVID period, we can see that 4.6% of variation is in BSE is explained by crude. 7.4% of the variation is being explained by shock in BSE, in crude. So you can see that the interrelations have increased and there is a spillover both ways. It's not that only from stock to commodity or commodity to stock. We can observe that the spillover is both ways. It's a bidirectional spillover. So these are the conditional correlations for pre and post-war. Similar thing is observed that between BSE and crude oil, the correlation has increased a lot. Same results we have got. And this is for the futures prices. Similar kind of pattern we observe in futures prices also. Previously correlation was almost nil, but after COVID, correlation has increased a lot, again around 0.6 to 0.8. And this is this result, as I have mentioned, post-war data is quite small, so we did not find much of volatility in the post-war period for futures prices. So there is no point in explaining this result. So this is the summary of the volatilities that we have observed. This is the volatility correlation between BSE crude pre-COVID. This was as low as around 0. Now it has become, the average is around 0.8, pre and post-COVID. And this is pre and post-war. And this is the pre and post-war. The correlation has remained to be quite high, around 0.6. Okay, so this is for similar for future prices. So if we come to the conclusion, basically what we have observed is that in the spot market, during the pre-COVID period, gold price influenced both stock return, but after that, at the return level, there was not much effect. Only BSE and crude, that was the relation. But in terms of volatility, yes, volatility played a very important role, and the spillover was bidirectional. Specifically, BSE and crude oil correlation has increased a lot. It has become positive, and the negative correlation of BSE and stock market and gold has come down. Similarly, the similar thing holds for the future market as well. And most interestingly, this increase in the correlation between BSE and crude oil prices was also observed in global financial crisis. That's all.
Thank you. Interesting presentation. Couple of questions.
Yes.
So this will be speculative on your part. So you're saying that the crude prices post-COVID have become much more highly correlated with BSE. What would be driving that kind of result, do you think?
See, what happens is that these are commodity futures. It has been observed historically that whenever there is market volatility, more volatility, people are moving towards more of safe haven assets. Now, previously it was most of gold, but for the last 2 decades, there has been a shift towards commodity futures also. Maybe they are investing there more rather than gold, and that's why the linkage between gold and stock market has come down, whereas the linkage between these two have gone up.
It's kind of curious, a very curious result, so I'm a little puzzled. Anyway.
Yes, Professor. Very interesting, but it's actually challenging to find the economic interpretation of this, because the correlations and the causal relationships actually. So now, when you again the point the earlier presenter and you also made a point about how do we actually perceive or define a safe haven asset. Now, a crude future being seen as a safe haven asset because of the volatility in the stock market, it actually will be a leap of faith. I mean, it's very difficult to, because the dynamics of a commodity like crude especially are very different. And gold definitely actually cannot be drawn in the comparison, even though gold has this commodity attributes. But gold actually will will feel very bad if it is being compared in the same breath. But the numbers, of course, are telling some story here. But we really need to understand first even the motivation part, because when you are I understand the way I have seen it, that India's crude pricing policy or oil pricing policy, if you have taken M6 futures and all, they are all rupee futures, and that market itself, even though it was say partially it was allowed to be passed on, but then it is steeped in so many other policy considerations and limitations. So, and then the relationship and the pass-through of the changes in the international prices, that also is controlled to a large extent. So how much when the it's very interesting again, just to add to the curiosity, because I'm also very curious, and this perhaps again needs to go back when you are looking at the event studies. I don't know, but why should we get into, because the one conclusion was this, that just like during the time of GFC, the correlation amongst the asset classes increased.
Yes.
But then that was almost a motherhood statement now. That is almost the definition of a crisis. That during crisis, what happens is that everyone is flying towards the same safe haven, perceived safe haven asset, and that's why the crowding effect comes in, and the correlations amongst the asset classes increase, and no diversifier effect. So that is one thing which is, of course, very clear. But apart from that, COVID period as a crisis, how was it different from the previous crisis, which were actually the crisis in the financial markets? The COVID crisis was different in the sense that it happened in the real, and then it had an impact on the financial markets as well. So that's where perhaps more nuancing will be required, even in the premise setting itself. And then the stock market, because there were some very, very peculiar behavior patterns that came. During COVID, because people were sitting at home, and otherwise they had access to everything else. The markets were there, and they didn't have to go out, and they could. So there was heavy inflow, or not inflow, I'll say, but heavy participation, a large increase in the participation of the retail investors trading actually, because people who had savvy but didn't have that kind of time perhaps, they got it, and now what kind of impact that would have had on the BSE returns themselves. So there are too many other factors. So I understand. I'm just completely talking from a non-academic perspective. But yes.
This is a wonderful point.
Yes, Professor. I just had these observations because I got curious.
It's a wonderful point actually. My sense is that part of this result is driven by the fact that as one variable, the sudden increase in the number of participants. If I correct for that, if I use that as a control variable, then will this still stand up? So perhaps one might want to revisit the specification, the variables that you have used over there.
So volumes you are talking about, like we
Yeah.
have to take into account the volumes. We have looked at prices.
Yes,
So
yes,
you are
yes,
talking about
yes.
volumes.
Transaction
We'll
volumes
think
and
about
so
it,
on,
yeah.
yeah.
Thank you.